What is going on, everybody? It is August 1st. Sorry for the delay on shooting this video here, but I got all the July numbers into the market data update, and here I'm going to go through it all, show you exactly what's going on, and we'll even talk a little bit of what's potentially to come. All right, so without any further ado, let's get into the market update. So currently, in terms of inventory, we have 334 units for sale on the marketplace, and that's made up of 169 singles, 19 semis, 71 towns, and 75 condos. So those units make up the 334, and as you can see, our 5-year average is 252. Last year, we had 98 homes for sale on the marketplace at this time, and currently we're at 334. So we have 32% more inventory now than we do regularly based on our 5-year average, and we have 240% more homes for sale now than we did last year. 2.4x. It's quite incredible how many more homes are on the market. And when we just look at the inventory mix here, single family attached homes, which were usually very depressed over the last year and a half, have significantly come up and well above our 5-year average. But as we look at the condo market here, the condo market is definitely the most oversaturated market currently when it comes to supply. So there you have it. So that is currently what's on the market and what's going on there. Now let's go into our listing inflow. How many units are coming to the market, which is how much supply is flooding into the marketplace right now. So we ended July with 283 units flowing into the market, which is still 3.8% above our 5-year average. So we pretty much nailed the average right on the head. Nothing too crazy there. Last year, we actually didn't have a lot of inventory coming to the market in July. So we are 25% higher than we were last year. But last year was a bit of an anomaly. We didn't have the average inventory coming in, which was a bit surprising. So yeah, I mean the inflow here is pretty regular at 9.1 homes per day coming to the market, and on average we have 8.8 homes. So inflow is pretty stable. Properties are coming into the market at a proper rate. Now let's take a look at the listing outflow and see why we have all this inventory. So obviously, if the inflow is proper, well, then the outflow must not be, because if it was, we'd be a little bit more balanced, right? So as you can see here, we have had declining sales since March. We kind of peaked out in March, 260 sales. But even at the 5-year averages, though, March is typically our highest month of sales here. As you can see here, 245 sales. The only other one that comes close is right here in June, and in May we have almost 240 units that sell. So yes, it is a declining trend. There is a lot of seasonality in real estate. So be aware of people that are telling you stats like, oh, market's down, sales are down considerably month over month. Yeah, every month is so much different in real estate. So you got to look at the averages, you got to look at the seasonality and really see what is the change based on what is typical, right? So this is an untypical change here. This is not the best data here for the sales. So we do have a declining sales trend, which is much more significant than our 5-year average trend. So only 123 homes sold in the marketplace in June, in July, which is only 4 homes per day selling. So that is a 43% decrease from our 5-year average and a 41% decrease from last year. So essentially half the amount of homes is sold. Okay, so here's another interesting data piece here. So if these homes didn't fail to sell, we'd have a lot more inventory. So these are the fake sellers I'm talking about, or the ones that are recycling constantly, where they're on the market, coming off the market, coming on the market, coming off the market. When you keep doing that, you're going to actually increase the amount of listings that are coming to market. So that's why in the past couple of months, the months that we hit those 400 back-to-back 400 months, we had an excessive amount of failed home sales, and we also had an excessive amount of new listings. So essentially, it was essentially the same homes just recycling themselves quite a bit, and that's pretty obvious in the data right here when you look at it. Like, look at the in those 2 months I just mentioned, where we had 400 units come to the market. We had 170, 173 homes fail to sell. And this month, it is declining a little bit. So we spiked here in June. It's coming down a little bit, stabilizing. It's still really high though. We have 4.8 homes failing to sell a day, which, as you know, we are only selling 4 homes a day. So spoiler alert, for the very first time, we've had failed sales exceed sold homes, which is quite crazy. So yeah, we had a 74% increase in failed sales over our 5-year average. And last year was a bit of an anomaly. No homes were failing to sell because you could literally sell it for anything last year, it felt like, right? So no homes were failing to sell. But that's the fail to sell, and that's essentially what's happening in, out, and out again with the failed sales. So here's some other stats, other indicators about what's going on in the market here. So our average days on market crept up to 20. So as you can see here, from the beginning of the year at 8, we have added 12 days to our days on market average, which is getting back in alignment with averages, right? So this is not unnormal. So people get very worried. Oh my gosh, the real estate market's crashing. Everything's going really bad. No, not at all. We're just getting back to a more balanced marketplace, and the market's just finding itself right now. So we're actually still one day under our 5-year average at 21. So just the last couple of years were really hot, and now we're finding a little bit more balance in the marketplace. So it's still actually a really good market. If you look at the numbers and you're really looking at some of these indicators, it's not that bad. It's just stabilizing. It's just kind of figuring itself out. One person that I actually was talking to, what they say is, when an initial change happens in a market, you have a normal marketplace, and this is the existing normal, and a big disruptor into the marketplace comes in. So raising interest rates, inflation. There's a big change that has to happen, and a change is introduced. Once that change is introduced, the old normal is now no longer existing, and the market is kind of in flux for a couple months. The average apparently is 3 to 4 months that the market is trying to figure itself out. And then once the market figures itself back out, it enters a new normal state. And this is pretty evident in our 2017 data as well. I know now I'm going to jump around. Now I'm doing analysis and telling you the information at the same time. I apologize. I know I told myself I wouldn't do this, but here we go. I'm already halfway in here. So as you can see here, in April of 2017, that is when the government introduced rates to cool the housing market. And what they did, they increased taxes on foreign purchasers, they increased the qualifying rate, and the interest rates increased as well. And that ended the new normal, which was very hot market, lots of demand, little supply. Sound familiar, right? From pretty much the beginning of this year and all of last year. And then they introduced this change, and then the old normal stopped. And then it took 3 to 4 months. As you can see here, there's a solid decline for 4 months. It was 18% peak to trough in 2017. And then it stopped and rebalanced and entered the new normal. And that new normal lasted for about 34 months until we hit peak prices here. And then, we had another disruptor. We had the health crisis come up, deflationary pressures, lowering interest rates, stimulating the economy, right? It created a new normal, right? So these things happen, and they're just cycles. It looks like here we're going to be entering the 4th month in August, so I'm going to be super interested to see what happens here. So I'm going to go back and keep telling you what's going on in the market, and we'll keep doing some analysis on that. I hope you find this information valuable, and you don't mind me going off the rails a little bit there. All right, so 21 days 20 days market price. The list price to sale price ratio, it is the lowest list price to sale price ratio we have ever had in a given month. The only month that was lower, or that was close to lower, was up here in November of 2014. Sorry, there's some bugs out here. 2014, where it was 96.8. So yeah, this is the lowest list price to sale price ratio. And if you don't know what that is, essentially, if you were selling your house for $100, you're on average getting $96.10. Right? And back in, January, if you were selling your house for $100, you were getting an average of $112. Okay, so that's the best way to explain that. So the monthly average sold price, as you can see here, we ended at $767,000, which was down 8.7%. And so for peak to trough here, we are down 23.74%. However, we are still slightly up on the year over year. We're up 3.6% still. Again, back in our regular normal markets. When I say back in the regular normal markets, I'm aging myself here. But in a stable market, in a real estate market, typically, since I've been doing this for 11 years, you like to see a 3.5 to 5% gain in a real estate market, and that was typically really good. And here it's like, oh my gosh, it's only up 3.6%. If you really look at the year over year data here, from 2014, you got 2014 to 2015. Where am I at here? Here we go. 2014 to 2015, 6% increase in 2015, 12% in 2016, 20% in 2017, flat in 2018, 6.3, 15, 23, 21. Yeah, so real estate has been extremely good to a lot of people over the last 10 years. And yeah, I mean, we're still up 4%, so it's nothing to shake a stick at. It's still doing better than 2018 is. And year over year, actually, we're still up 21.57%. So it's still a crazy strong real estate market, as you can see. Um, it's just coming to a cooling, and we're going to be entering into a new normal. So let's take a look at anything else I want to show you here. Average quarterly sale price quarterly. So this new quarter, it's at 767, which is down 16% from the previous quarter. That's only 1 month of data in there so far. And year to date, quarter over quarter, it's still up 1.17%. Okay, perfect. So that's essentially what's happening here. And looking at the inflow report here, year to date, so far up until right now, we've had 2,402 units come into the market. That's 346 more than our 5 year and 176 more than last year. So as you can see, 16 and 8% increase there. Total units sold year to date, 1,362. That's down 8.1% from our 5 year and down 25% from last year, where last year it was on fire and everything was selling. And total failed to sells. This is the crazy one. 719 homes have failed to sell. And we're looking at around 306 more than our 5 year, 74% more. And then versus last year, 110% more homes are failing to sell right now. So a lot of inventory is just coming on and recycling. So total units that we have added to our marketplace this year, we have added 321 units to the market, and that's why we could see, we started January with 69 units, and now we're up to 319. I know that math doesn't work out perfectly. It's not a perfect data track, but it's very accurate to as you can show the trends, right? So over time, we're adding enough inventory, and this gray bar line here is the current inventory, and the dark gray is the 5 year average, and you can see that we finally caught up in May, and now we surpassed it, right? So taking a look at that. Um, so the total today's inventory is 334 units. So we're going to talk about absorption rate here. That's an inflow of 9.1 homes per day. So if we continue getting 9.1 homes coming to the market every single day, there's going to be 274 new units to the market. So if you add the 334 plus the 274, that's going to give you the 608 homes right here. And then if you look at what's going to go out of the market in the next 30 days, so with home sale rate at 4 and homes fail to save is at 4.8 homes per day, that's going to give us 8.8 homes per day are going to fail to sell. So 263 units are going to come off the market. So essentially, in the next 30 days are going to be another 345. That's where I'm predicting the inventory to kind of land in the next 30 days, around 345 units. And that being said, if 4 homes on average sell a day, it would take approximately 2 months, 2.9 months to consume all the inventory if no new inventory came to the market. This is called absorption rate. It's how many months of inventory do we have left if no new markets came onto the marketplace, no new homes came onto the marketplace. And around 3 is a balanced market, and we're at 2.9. So we're right around a balanced market right now. And it's going to be really interesting to see what happens in August to see if we go down a little bit more, hit that bottom, or is it going to be a bottom? Is it going to accelerate or stay flat for the next little while? And September is really going to be the telltale. Is it going to be like 2017, where September it recovers a little bit and things alleviate in terms of downward pressure? Or is it going to continually see downward pressure because the changes are more significant and abrupt this year than they were back in 2017? So that's what we have to see. A couple of things that you might want to know about, the 5 year historical mortgage rate. As you can see here, it's just skyrocketed over the last little while. And people are saying, yes, the Bank of Canada is raising interest rates, that's for sure. When the Bank of Canada raises interest rates, what happens is that the prime rate is set, and then there's usually a spread put on the banks for that, and that's usually affected by the variable rate. But the fixed rate is more based on the 5 year bond market. And currently, the bond market over the last little while, if I can pull it up here, Currently, we're at 2.62% on the bond market, and usually banks, typically like the RBCs and the BMOs of the world, they're typically looking for a 1 to 2 point spread on the bond yield. So if it's at 2.6, banks are going to look for 3.6 to 4.6%. And as we can see here, I believe I got this one up. Let's see if this one gave it to me. No, this is the 5-year Canadian bond. Here, yeah, sorry, I was right here. We're currently at approximately 4.34%. So pretty close, right? So we're between the 1 and the 2. We're about 1.75% higher than the existing bond yields. And this was updated. When was this last updated here? It's kind of hard to get there. It was updated yesterday. So 4.34%. If we're at 2.6, that's 30. So yeah, it's about 1.7% above the existing bond yields. And we're essentially back to mortgage rates that we were in 2010. So we haven't seen mortgage rates like this since 2010. But the good news is that, if it's true that the bond market is in alignment with the mortgage market, and you look at what's happened over the last, let's take a look at the last 6 months here. We did peak out up here in June, and we have come down. So mortgage rates have been alleviating on the fixed market, and now we're about 2.6%. So I know that hockey stick growth on the mortgage side. So this is the rule of thumb. Banks will always be very, very quick to raise interest rates when bond yields go up, but when bond yields start peaking down, the banks are usually pretty slow to keep moving with the bond market. But if the bond market continues to drop or continues to stabilize down a little bit lower, you may see fixed rates come down. So I hope that was helpful. One of the things I'd like to potentially discuss here is what does the future hold here? Again, I'm just really going to keep going back to 2017 and looking what happened there. And if you're looking at what happened in 2017, with the average sale price, which is right here, if you look back at 2017 with the average sale price, August was the bottom back then. It had a 4-month consolidation period, 4-month figure it out period. I'm really going to be interested to see. So September is going to be the month where we're going to see have things flattened and stabilized. Oh, I just deleted something that I shouldn't have. There we go. Is it going to flatten, stabilize, or is something else brewing? Are we going to continue to go down? So if you are in the market right now, you don't. So in terms of advice, if you are in the market to buy, right? It's like, well, Steve, interest rates are going up. They may come down a little bit on the fixed market. I understand that. But I want to buy a property. Should I buy right now? And the answer to that is it depends on your situation, and we need to look at your goals and see what kind of time horizon you have. If you are looking at buying right now, I know there's sellers in the marketplace that understand what I'm talking about here, that we're coming maybe to an end of a down cycle, but they still want to potentially need to sell because there's always someone that needs to sell. There's always homes being sold. So if they need to sell, they're going to aggressively position their home ahead of the competition. Right now, you have to see there are a lot of sellers on the marketplace right now. If you go into what's on the market, right, we have 334 homes. So if they're a single family detached, they have less competition in the semi, but in the single and the condo and the town market, there's a lot of competition. So you have to aggressively position yourself, and you'll find a motivated seller that may give you the September price today to move because they know they need to get ahead of the knife because they don't know what October has in store. So they may need to get out. So if you are looking at potentially shopping at great deals, there could be some great deals on the market for you right now. And if we get your setup, we get all your ducks in a row, you don't want to be, you don't want to find the perfect deal and then not have your ducks in a row to execute on that deal. So if you are interested in buying, we should talk. We should get your ducks in a row. And on the other side, if you're selling, for sure, there's definitely inventory on the market. You're going to be competing against other assets. If you are selling, it really depends again on your goals. Why are you selling? Do you have to sell, or are you making a switch? Because a switch right now is actually an advantageous time to switch because home prices are lower, so therefore you're going to pay less commission because 5% on a million is a lot less than 5% on 800,000. And if you're switching to another asset, if you're switching to an asset that's actually higher than yours, if the market has come down 23%, if you're at a million and the one you're going to buy was at 1.2, and it dropped 20%, you're at 800,000. Well, that asset that was at 1.2% is going to drop more in a dollar value pound for pound if it's down 23% across the broad market. So you'll actually save money on the buy as well. So you're going to save on commissions, save on the buy. You're also going to save on land transfer tax because the one you're buying is less money. So technically speaking, you don't want to be swapping at the top. You want to be swapping when things come down a little bit so you can actually save yourself essentially tax-free money, because it's all when you sell your primary residence, you're not taxed on it. So, if you're saving 100 grand or 200 grand, if you look at it from a tax-free perspective, for you to make that same kind of savings in income, you add about 30-40% to that, because you have to pay taxes, right? So that might not have made sense. But if you were following with me there, it's a great time to switch, downsize, upsize, a great opportunity for there, especially if you can port your existing mortgage over. Because, for example, if you refinanced and you had and your mortgage is pretty new and you got a substantial mortgage, yeah, the house value may have come down to here. So since the new asset has also come down in value, you might not need to take more equity in on a new mortgage. So you might be able to port that mortgage directly over. So then you can still take advantage of the super low interest rate you got. So lots of great opportunities there still. Again, this stuff may have gone over your head, and that's okay. We're here to guide you, to give you a 5-star real estate experience. So if you need some guidance, we want to help you. Feel free to reach out. Hope this is helpful. Thanks, everybody. Have a great night.